Hey, thanks for tuning into Harvesting Income. Today I'm going to talk about IWMW, which is the Russell 2000 BuyWrite ETF, because this has been covered 1 year ago, and I feel we have to relook at that and see the performance, what is going on, latest updates, and how things are. So let me quickly give you a overview of this fund. This is the iShares Russell 2000 BuyWrite ETF. um, some of you might have seen my previous videos, and I called it a boring ETF, and the one with good potential. But let's see what has been the performance so far. Uh, yeah, so it was launched back in September 2023. It's about 2.5 years. It's going to be 3 years now, and the price is $38.79 as of June 12th. Net assets 51 million. So it's a kind of a smaller fund, and it holds the Russell 2000 index ETF, which is IMW, which is part of the same fund, which is part of the iShares. So they hold IMW, and the fund writes call options on the IMW. So you can see on my screen the strategy. It's about holding the IMW and writing calls, which are 2% out of money, which means this fund provides some upside within the covered call portion. So obviously the fund writes covered call on the entire portfolio or majority of the portfolio. So that's the basic investing strategy. Now for this, the expense ratio is 35 basis points, 0.35, which is reasonable, and they distribute, uh, distributions every month. And based on the calculations that I've did, during 12 months, it's been about 6.7% distributions. And in terms of the price, they made about 0.6 percent. So the total return comes to about 7.3. Yeah, but this is just for the last 12 months, 1 year. Let's look at the performance in detail, because this is just the 1 year data. But let's look at different time periods and see how it performed. And also let us look at how it performed versus other funds or peers or let's say competitors. Let me go back to my browser, and here I can show you the comparison. You see iShares Russell 2000 on the screen, $39. Yeah. So on the left side, I'm going to show you this one. I am IWMW, which is in orange color. I think it's at the bottom of the list. And IWM, which is the index or the index ETF, that's the benchmark. So the purple one is the benchmark, which is at the top. And when I compared it with IWMI from NEOS funds, and I also compared it with RDT, which is from the Roundhill. RDT gives like weekly distributions, and they do um, something called the zero DT covered calls, which means they write calls almost every day, and they distribute the premium income every week. So, looking at the performance of these funds year to date, um, starting from January 1st of this year uh, till now, like around middle of June, we see that on screen you can see yourself. I will zoom it a little bit. Uh, the top performer here is IWMI followed by RDTE. So IWMW is actually slightly lagging behind. Index gave you 18%, but our fund is giving 10.2, which is very low. It's slightly above 50% in terms of capturing the returns. So I am comparing the total returns of all the funds. So which means the distributions plus the price returns. So obviously it's not doing well year to date. But if I look at the last 1 month, excuse me. Yeah, in the last 1 month, you can see that the fund is performing well, almost matching the index, 5.54. Index is about 5.62, IWMI 4.8, RDTE 5%. Yeah, in 1 month period, it has been doing well. Let's look at 1 year. Okay, okay. Now the winner is the NEOS fund with 35.3. The second runner-up is the Roundhill funds, RDTE. It is giving weekly distributions. People who are getting weekly, payouts, they would be happy seeing this. And unfortunately, IWMW is uh, third on the list, 25.5%. Again, not bad. I would say 25% in 1 year total returns is pretty good. So it has its own good points, but it is not matching the performance of its peers because of the systematic nature of its strategy. There are pros and cons of their approach. I will come to that at the end. But let's look at the longer term performance, 3 years. Okay, I can see that the orange start line on the chart starts from around March 2024 because the fund is a little bit um, not 3 years old, but probably shorter than that. Anyway, so let's see where we stand. The winner in this case is IWMI, obviously 40%, 40.3, and followed by Roundhill RDTE at 36. Again, RDTE is also a recent fund, and IWMW is 27.11. So that's about it. That's where things stand. So as so far, like the IWMW is underperforming when I look at the 1 year and 3 year returns. So I'm looking at the long term returns because that's where we need to be focusing on being medium term or long term investors. So yeah, coming back to the main points, what I would like to say here is there are some cons with the IWMW. There are some drawbacks. I'll explain that as we move ahead. Uh, Coming back to this screen, there are two things that you need to see in terms of the difference. Why other funds are performing well. I just captured my notes or points so that I don't get distracted here. So because if you look at other funds, for example, there is also a Global X RYLG, which also performed well. I can show you on the screen here. We talked about RDTE, but let's look at RYLG as well. RYLG, because I made some notes about this fund as well. So I have to show you that. See, if you look at the 3 year performance, RYLG is actually beating everyone. That's the surprise, wild card in this competition. It's beating everyone on a 3 year basis. If I look at 1 year, yeah, again, it's beating everyone. It's pretty close to RDTE, like 29, almost 30%, and RDTE is 29%. So that's the point I want to explain here. Let me go back to the document. So here I have captured my notes so that I don't forget to mention that. This RYLG has 50% coverage, which means they write calls on 50% of the portfolio. So the other 50% is able to capture the full appreciation of the underlying stocks. So that's the beauty of the Global X RYLG fund. It The 50% of it appreciates with the index, and the other 50% is subject to the covered calls. So more upside on the index in the recent times have helped the fund. So that's why RYLG outperformed the um, IWMW. Now, what about the NEOS funds, IWMI? They do forward calls, plus they also do call spreads above the higher strike price to capture the extra returns on the upside. So they are able to you know capture extra returns which are usually capped for traditional covered calls, but neos funds is able to capture that extra based on the credit spreads. So what they do is they write contracts with some coverage, and and they also write additional contracts with additional coverage. So what they basically do is, instead of doing just one call, they are doing one at a certain price and two at a second covered call contract at a higher price, probably a third one at a much higher price. So I looked at the news uh, holdings. If I look at the holdings recently, this is what I found. They wrote one call at 2990, expiring on July 17. Okay, you see that on your screen. July 17, they wrote a call at a certain price, and they are getting income for that. The current Russell is probably lower than this. Like currently, it's around 2900. Now they also wrote another July 17 call at 3050, much higher level, out of the money. It means they're capturing the appreciation up to 3050, 3050. So that provides more room for upside, and apart from the income that they're generating. That's something I like with IWMI. But the problem with the iShares IWMW is they just write one call every month with a systematic method. However, the point that you need to keep in mind, the low return doesn't mean uh, poor fund or poor in terms of the quality. The only issue is that you have limited returns. So covered call funds capture upside and downside. But in this case, what's happening is you are capturing the uh, downside, and some premium is compensating your downside, right? As a cushion that I mentioned in some of my videos, the premium gives you that cushion to shield you from that volatility, but it cannot completely give you protection against the entire downside. It can protect you from that downside, giving you a smoother ride, you know, to move up. So that's the advantage of the covered calls. IWMW is a good fund, but if you are looking for higher returns and higher appreciation, you can look at RYLG, IWMI. The Roundhill RDTE is also a good option. I would not say it's a bad fund, but you need to know how the zero DTE calls work, and you need to be comfortable with the volatility. So if you're comfortable, you can pick one of these funds. But please keep in mind, like we talk in all the videos, like this fund invests in the Russell 2000 stocks. So are you comfortable investing in the Russell 2000 underlying stocks? If the answer is yes, then you can look into one of these funds. So you have looked at the IWMW, and now you can make a decision whether you want to invest in it or not. I hope you like this discussion and a very fair, balanced analysis of this fund and comparison with other funds. If you'd like to see more videos like this, please subscribe to this channel and stay tuned. Thanks a lot. Have a nice day.